This is something that not many people know about me, no matter how many videos you've watched about me. I started my career as an options market maker on the floor of the London International Financial Futures Exchange. It was a futures and options exchange. I was a market maker in short sterling. Now, because I've got a lot of experience in derivatives, it's quite interesting when people who are used to trading Forex have this fear of futures. They think that they need to understand how futures contracts work in order to trade them. And that's actually not really the case. The price of futures contracts just move up and down, like the price of Forex or commodities. It's just that futures make some contracts more accessible to trade. For example, if you want to trade oil, you're going to normally trade the oil futures contract because you're not going to trade physical barrels of oil or physical bars of gold. So the futures contracts give you an opportunity to trade these kind of markets by paying a small margin. So you get access to be able to trade quite a lot of oil or quite a lot of gold for a relatively small amount of money through the futures contracts, which is obviously a lot simpler than going out buying a barrel of oil or a bar of gold. Futures contracts don't trade at exactly the same price as the underlying. The underlying would be the cash price of gold or the cash price of oil, because futures contracts have expiries in the future. I'm now talking to you at the end of October. The next expiry for the US stock markets, the S&P, the Dow Jones, the Nasdaq, the next expiry for those markets is in December. And so the price of the December futures would be slightly lower than the cash indexes. There are four main types of derivatives contracts, which are futures, options, swaps, and forwards. A futures contract is just a standardized contract in terms of size, delivery date, and the conditions of the contract, which are set by the exchange. And this just means that everyone who buys or sells a futures contract knows exactly what they're getting. They know the size of the contract, the expiry date or delivery date of the underlying. Now, some futures contracts are settled to cash, which means that when the futures expire, you make up the profit or the loss on your contract in cash. So if you lose, you pay cash to the exchange. If you win, you get cash from the exchange. So for example, if you're trading oil, you don't have to deliver barrels of oil. If you're trading gold, you may not actually have to deliver bars of gold, or you may not have to take delivery of bars of gold. So these tools are primarily set up for speculation or hedging purposes, not necessarily long-term investment of oil, gold, or the stock markets, or whatever it might be. When you trade Forex, you're actually, in theory, trading with a counterparty like an investment bank. So Forex is traded over the counter, which means if you're a big Forex trader, you might phone around various different banks to ask them for a price, and then you'll deal directly with the bank. Whereas futures and other derivatives contracts are traded through exchanges. So for example, the Chicago Mercantile Exchange is probably the biggest derivatives exchange in the world. And there is a daily settlement mark to market. So each day you'll have a P&L calculated by the exchange, and you may have to pay increased margin if your position goes into a loss. If it goes into a profit, the margin might decrease and you might actually receive some money back on a daily basis from the exchange. Which brings me on to the next point. One of the biggest advantages of trading futures is that it's a leveraged market, which means you can buy an immense amount of gold for a relatively small amount of money. Now, leverage is a double-edged sword, of course. When you use leverage and you make a profit, that can work really, really well because you're not putting up a lot of money, but you're getting a lot of exposure to the underlying. And if things go well and you make a profit, you can make a huge return on the money that you've paid as margin. But of course, works the other way around. When you're facing a loss, you can get wiped out fairly quickly if you're not extremely careful. So you've really got to understand what you're doing when you're trading a margined product, because the risk increases dramatically. Now, just as futures are a derivative of the underlying, I'm going to use gold again. The gold spot price is the cash price of gold if you want to go actually out right now and go and buy a gold bar. Futures are a derivative of the cash price because it's what people expect the price to be in, let's say, 3 months' time when the gold price expires. It could be linked to the underlying, to the cash price, but it won't be the exact same price as the underlying because it's used to speculate where the price is going to be in the future. Now, options are a derivative of futures, and they allow you to speculate on where price of the future will be at a date in the future. Now, this gets a bit more complicated. Options are divided into puts and calls. Call options give the buyer the right to buy the underlying at a predetermined price in the future before expiry. So let me try and explain that. If gold is trading at $2,700, I could buy the $2,800 calls for a relatively small amount of money, and that will give me the right, but not the obligation, to exercise that call sometime in the future before the expiry date, and it will allow me to buy gold at $2,800. Now, why would that be useful? Well, it'd be very useful if the price of gold goes up to $2,900 before expiry, because I can then exercise the option. I can buy gold at $2,800, and if I've only paid $10 for the right to do that, I could be looking at a $90 profit, or I could 9 times my money in a relatively short period of time. You get a huge amount of gearing on options, and when they work, you can make enormous returns on your investment relatively quickly. And who do you get to buy that gold from if you exercise that 2,800 call? It's the person who sold you the call. They have to deliver gold to you at $2,800. Now, that doesn't obviously work very well if the price of gold is $2,900. The seller of that option is looking at a huge loss. But if gold never gets to $2,800, the amount of premium that you've paid for that option will be gone. It'll expire worthless. So you'll lose everything that you paid for that call option, and that amount of money will go to the seller of that option. So some people like to sell options in the hope or expectation that the option will never get exercised because the price will never reach that point. And that is a nice way to make a little bit of extra income by selling options that they expect will never be exercised, or the price will never reach that point. But of course, it can be a high risk strategy, because if gold does shoot through $2,800, goes to $2,900 or $30, you could be facing a big loss, and you'll need to cut that as quickly as possible. A put option is the opposite of a call option in that the buyer of a put option has the right, but not the obligation, to sell the underlying at a predetermined price, which is called the strike price. Now, if I bought the $2,600 gold put and gold collapsed to $2,500, my gold put would be $100 in the money. And so I would obviously want to exercise that put before expiry. I could sell gold at $2,600 and I could buy it back at the current price of $2,500 and bag a $100 profit. Again, if I'd paid $10 for the ownership of that put, I could be looking at a $90 profit. I could 9 times my investment quite quickly if gold were to have a 7% move to the downside. Now again, the seller of that option might receive $10 for selling the option. If the price of gold never gets below $2,600, the seller of that option will just take that $10 as a profit. But of course, the seller assumes quite a lot of risk, because if the price of gold does collapse, they are in for a rough ride. The amount of money that I would pay to the seller for the option is called the premium of the option. And as I said earlier, premium sellers are those that are looking for the price of the underlying to stay fairly stable, and they're looking for the premium to erode over time. The premium represents time value. So if the option's going to expire in 3 months' time, that $10 is going to erode as the weeks go by, and the seller of that option is going to see profits gradually coming into their account. Of course, the holder of that option will see the value of that option erode over time. But if you're buying that put option to protect yourself because you own a lot of gold and you're concerned that gold price might collapse, you could, instead of selling your gold, you could just buy a put option, which gives you that protection. You may not mind losing the $10 on every contract for that trade if it means you can hold your gold in the longer term, but be protected if gold suddenly and unexpectedly collapses in price. So as well as the premium, options are made up of a strike price. That would be the $2,600 in my put example. The strike price is the price at which the holder of the option can execute and sell if he owns a put, or he can execute and buy if he owns a call. And then you have the expiration date, which is set by the exchange. So for example, index options expire on the 3rd Friday of the month. Okay, I hope that's helped to explain a little bit about derivatives, futures and options. If you found it useful, please like, share and subscribe, and please do post your questions in the comments and I'll try to get back to you as quickly as possible.